In this video, we will discuss how investment banks allegedly tricked investors in mortgage-backed securities. Allegedly, investment banks hid important information about securities they were selling. When talking about these investments, a term you will frequently see is RMBS. RMBS stands for Residential Mortgage-Backed Securities. When a person buys a house, a residence, they typically get a loan from a lender. The lender has an interest in the house that we can call a mortgage. There are various ways that investors can invest in securities based on this mortgage, and they're known as RMBS, Residential Mortgage-Backed Securities. Generally speaking, the investors are betting that the loan is going to be repaid, that it's a safe loan. Investment banks sold RMBS to investors. The investment bank's assets were also tied to RMBS. Allegedly, around 2006, investment banks realized that RMBS were at risk because home buyers could not repay their loans. The investment banks concluded that RMBS, as of 2006, were bad investments. The investment banks also realized that their own assets were at risk because RMBS were at risk. But the investment banks also realized if they bet against RMBS, they could make money. Some investors were also aware that RMBS were likely to fail. The investment banks and some investors realized if we bet against RMBS, we can make money. Investment banks and investors could profit from homeowners being unable to repay their loans. Investment banks, or the favored investor, would select a particularly risky RMBS product and sell it to other investors. You'll see the type of investment used here referred to as a synthetic CDO. We're not going to discuss synthetic CDOs, but feel free to get in touch with me. So now our investors are betting on RMBS, but the investment bank and the favored investor are betting against the RMBS. The investment banks allegedly failed to provide complete warnings. They hid risk from the investors. In some cases, investors were not told that another investor had selected their product and was betting that it would fail. Investors were also not warned that the products were considered so risky they were expected to fail. And the investment product did fail. Investment banks and favored investors made money because they were betting on that failure. If the investment banks had disclosed that they or the favored investor were betting against the investment, or if the investment banks had disclosed all the risks, the investors would never have invested. If you'd like to discuss the cases against the investment banks or any other matter related to U.S. law, stop by the message board and please visit my blog. Also, feel free to submit your comments below and to send me an email.